Good afternoon, and thank you for joining us and staying calm when the markets go wild. My name is Sean McDermott, and I'm the President and Certified Financial Planner with Summit Investment Advisors. Along with me today, I have Nathan Krampe, who is the Vice President and Certified Financial Planner with Summit. A couple of housekeeping items Nate would like to mention before we begin our conference call are as follows.
Yes, I want to thank you for joining us on our conference call today. Each one of you should have received an email in probably the last about 10 minutes or so with the slides that we'll be going over today, as well as our most recent market commentary that we have sent out regarding China and their impact on the market. So with that, as you have questions, we would be more than willing to go through them. Please use your chat button that you have, and you can actually input your question, and then we will take some questions at the end. If you do have issues and trouble hearing us, you can definitely turn up the volume on your speakers so that you can hear us clearly. Lastly, I want to just make note that for those of you who have not input your name into the system, please go ahead and do that so that we have a record of who's attending today. And with that, we will actually have a replay of this available on our website here in the next day or so. So be looking for that as you want to share this with people and actually be able to watch it again.
Okay, thanks, Nate. So I'm sure a lot of you might be worried about what's going on with the stock market. In the last 4 trading days, the stock market has actually gone wild with the biggest price swing since November of 2008. So it's been a bumpy year with news headlines, everything from the China slowdown fear, the Greek debt market crisis, lower oil prices, and the Federal Reserve possibly raising interest rates, just to name a few. Every day it seems like there's something new to worry about. And what we want to do today is just give you some ways of coping with today's market and to try to help you keep a longer term perspective. So what I'd like to say right now is take a deep breath, exhale, and follow along with the presentation as we give you some perspective and some tips for dealing with the ride that we're on right now. So these slides I'll be going through, as I mentioned, or as Nate mentioned, are in your handouts. And the first slide is a disclosure slide. I'll let you read that on your own. What we're looking at here to begin off with is, you've heard this before, but I think it is still probably the most important concept in investing, and that's time is one of the investor's greatest allies. As you can see in this chart, since 1988, stock returns as represented by the S&P 500 stocks have been positive and have outpaced other types of investments. So the second line here would be bond investing over that period of time, cash investing, and then, of course, our typical inflation rate or normal inflation rate. So over time, stocks have historically outpaced bonds, have outpaced cash, and have outpaced inflation. Now, you'll probably notice in this graph also that it's not a constant straight-up ride with stocks. There's going to be times that we have robust growth with stocks. There's going to be downturns in the market. And so it's a little bit of a roller coaster effect sometimes. But again, where we're sitting right now is up here, and a lot of investors will say, well, you know, it's been a pretty good run for the last 6 years since 2008 with the stock market. We're due for a correction at any point in time. And of course, all investors are going, okay, well, we're due for a correction, so sometimes it's almost like a self-fulfilling prophecy that we're going to have a correction. And everybody's looking for it and waiting for it. Now, what we're seeing are a couple of the fundamentals that we do have to look at is, one, where are the prices of stocks, or how are the prices of stocks today compared to what the 25-year average has been? Now, when we look at stock prices today, they are actually below the 25-year forward PE ratio averages. So stocks, by comparison, are at probably at a buying point right now as far as pricing is concerned. So now let's talk about the current market environment. First of all, market volatility, and we sent out a handout which was emailed out yesterday, and then we also emailed it out again today, that discusses market volatility. And if you have a pencil, I'd like you to write this down. This is really important. Stock volatility is a normal occurrence. In 30 of the last 34 calendar years since 1980, 30 of the last 34 calendar years since 1980, the stock market, as measured by the S&P 500 index, declined into negative territory at some point. So basically, a part of investing is the market is likely to see negative territory at some point during the year, and that's likely what we're seeing right now. So markets will move up and down. However, the duration of the current bull market, as I mentioned, people have been pretty comfortable with the ride up in the market, and now people are a little bit more sensitive, or investors a little bit more sensitive to the pullback. And we're close to a 10% pullback in the market. And so what we want to do is talk about some of the reasons as to why the market might be pulling back right now in value. So the first reason that we're seeing right now in the short-term sell-off is the world's second largest economy, China, is slowing in economic growth. And what China has ended up doing is they said, okay, well, we're going to unveil a monetary and fiscal policies in order to boost their economy. And it's no different than what we've done here in the United States, or what Europe has gone through, or Japan has gone through. But it seems to be like a big surprise to everybody that China's slowing, and then they need to get their economy, or give their economy a boost. The biggest question that we're asking right now is, could the slowing growth in China derail the U.S. economy? Now, when we look at the numbers, we find that U.S. exports to China average in the range of 1% of our U.S. gross domestic product. So we are not big exporters to China by any means, and we're finding analysts and economists' opinions that don't think that the slowdown in China could actually derail the U.S. economy. So that's not a huge concern for us right now. Let's talk a little bit about this next slide. And as you'll see here, that when we go through corrections, or when we go through bear markets over the last 30 years, if we're taking a longer-term point of view, that sometimes these dips in the market could actually present buying opportunities for investors. So it's not often, but every once in a while we'll get phone calls when the market goes down from investors saying, you know, I've been looking for that buying opportunity, and I want to buy some more shares of that stock, Sean. So hopefully those calls start coming through real soon here. But maintaining the perspective on all this, the past bear markets, you probably remember, like in the 2000s, that was created by the tech bubble, and then the 2008 bear market was created because of the subprime mortgages and all that good stuff. But yet our view is that investment opportunities in other areas of the stock and bond markets, both inside the United States and overseas, even though it's always been, in my view, that one of the best strategies to help reduce market volatility is to invest in stocks and bonds of fundamentally well-run companies selling at reasonable prices and good sectors and strong industries in the U.S. and overseas. So what I'm saying here is stocks, what we're finding, even though the market might be at this point right now, we're finding stock valuations, again, are at or below their 25-year average PE ratios. So where are we seeing strengths right now in corporate America? As I mentioned before, we sent out a handout on this, but we're seeing that S&P 500 companies' earnings grew at a strong 9% year over year in the second quarter of 2015, and we believe the overall earnings picture will only continue to improve for the remainder of 2015. A quick dive into our economic outlook is that jobs growth is strong here in the U.S., company profits are growing, and strength can be found primarily from the sectors of auto sales, home sales, and healthcare. So our economy is basically expanding right now at about a 3% GDP growth rate. This is unspectacular, but it's actually pretty solid. Another issue I think that we should probably talk a little bit about while we're on this chart is that oil prices have come down dramatically over the last year. So oil was priced at over $100 a barrel. Now it's below $40 a barrel, pretty close to $40 a barrel. So that's quite a swing and reduction in cost of oil. That has beat up the energy company stocks, but we think it's going to be a huge benefit to consumers who enjoy cheaper prices at the pumps, and businesses find manufacturing costs lower given more modest energy input costs. Thus, the decline in oil prices is a bigger economic earnings benefit than a drag. So, with that said, again, we think this market, at this point in time, the economy is strong, the U.S. Markets are growing, stocks we don't feel are overpriced, so we don't think we're going to see a big collapse in the market at this point in time. Let's take a look at the tale of three investors and how they made time work on their side, and then another important concept which is called asset allocation and diversifying and rebalancing. So we have three investors here that each have $1,000 a year that they're investing over a 20-year period. This first investor invests their $1,000 a year into the best performing sector of the market from the prior year. So what they're doing is they're saying, okay, this has gone up a lot, I'm going to put my money here, and over a 20-year period they end up with $38,917. The second investor is putting their money into the worst performing sector from the prior year, and they're hoping that that investment will eventually go back up, and over a 20-year period you can see they end up with $38,594. So both of these scenarios are pretty similar. Investors either chasing returns or investors trying to get into things that have really bottomed out. This third investor, what they're doing is they're spreading out their money and rebalancing. So they're diversifying equally between 8 different market segments over a 20-year period, and at the end of every quarter they're rebalancing their portfolios to take advantage of the markets and to equally distribute between key market segments. And as you can see there, the investor ends up with $47,000. So again, we really feel that a well-managed portfolio allocated between different asset classes like stocks, bonds, real estate, alternative investments, investors who are properly allocated are typically going to be able to ride out the volatility in the stock market because they have a strategy in place. And we often refer to our 3D strategy, which would be the D for diversification, 1,000-year-old principle, don't put all your eggs in one basket. Second D is dividends, which would be making sure you're getting paid for taking the risk in the market by having good funds that are paying monthly or quarterly. And then discipline is a third D, which is much easier if you have a good plan in place to ride out the storms in the market. Now, let's go into the next slide here, and this is pretty interesting to look at. We call it the law or flaw of averages. And this looks at the Standard & Poor 500 between 1926 and 2013. So basically, we're looking at about an 87-year period. Now, in this slide, you'll see the average return of the stock market over that period has been 10.01%, or about a 10% rate of return. Now, how many times has the stock market returned an average of 10%? Over this 87-year period, the number of calendar years the market has returned between 9 and 10% has been 0. So what we're saying here is, the average of the market could be 10%, but it's very rare that the investor averages a 10% rate of return year by year by year by year. And so it just hasn't happened in 87 years. This next number here, 5, that's the number of calendar years the return was between 8 and 12%. And again, this is pretty surprising. The market is only 5 times in the last 87 years, average 8 to 12% rate of return. So again, if you're looking for, consistency 9 to 10 to 8 to 12, but believe it or not, it just doesn't happen year by year by year by year. It's, again, time in the market. The last number here is 24. That's the number of calendar years the return was negative. So the average return of the S&P was a minus 10.95%. So 24 of the 87 calendar years, investors experienced a negative year. And again, past performance is no guarantee of future results, but as you'll see from this chart here, when you're investing in stocks, it's a matter of average time in the market, not the market timing. This next chart here talks about investing across multiple asset classes. These are the average returns between the best and the worst type of investment over the last 10 years. And as you can see here, for example, in 2004, real estate investment trust, REITs, had a 30.41% average rate of return, and so that was the best performing asset class. And at the very bottom of the chart was cash, was the worst performing. So then the next year, REITs became, they're still a pretty hot investment, but then commodities were the best investment in 2005. And then REITs became one of the better investments, and then it became one of the worst investments. And then you can kind of see REITs climbed up in value again to become one of the best, to one of the better averages, and then kind of slowly went down. So whenever you're investing in any one of these sectors, whether it be large cap value stocks, you can kind of see it can be a pretty wild ride if you're just in one asset class. And I don't know if I told you about this, Nate, but I actually on Saturday I took my kids down to Valley Fair, and I went on just about all the roller coasters with them. And there's one roller coaster next to Highway 13, and it's a big green roller coaster, and it's called the Wild Thing. And the Wild Thing, it goes up, it goes down, and you get to some pretty high G-forces. And after I went on those roller coasters for the day, my wife, I told her I was a little bit sick, and I don't know. I think next year I'm going to stick more with the easier roller coasters. There's one in particular in the middle of the theme park, and it's called the Mild Thing. And the Mild Thing represents it. If you look at this chart again, if you see this black box here, and it says Div Portfolio, this is actually a diversified portfolio of stocks. And you can see it's a much smoother ride when you're invested in, spread across the multiple asset classes. So you don't get the big swings in the market. And again, that's what we want to do as investors, is be diversified. That way it's going to be a lot easier to ride out the swings that we're experiencing today. The next few slides do talk a little bit about the different asset classes, and I'll give you some definitions. And then my last slide to sum it up is, what have you learned today? Well, first of all, bear markets happen, but they also end. How you react to them depends on your long-term view and your short and long-term financial plans. I can't stress enough how important it is to work with your advisor to understand your financial needs. The more turbulent the markets, the greater the need for professional guidance to help temper emotional response as the events unfold. So I hope this presentation is helpful in calming some of the fears about today's markets and giving you ideas for moving forward with your investment plans. Based on what we talked about today, I would like the opportunity to discuss today's markets with you and then factor them into your long-range financial plans. So hopefully the next, when the next markets appear to start going wild, you feel confident enough to confident enough to hold on to your plans, sit back, and be a disciplined investor. So for those who are listening to the conference call today and that would like to review their investment plans or portfolio, we'll be reaching out, or you can call us anytime. And at this point in time, we'd like to, if you have any questions, feel free to chat in, and we'll try to address them as we go through here.
Yes, and I also just want to say, kind of to reiterate what Sean was talking about, that there's a lot of times that people are actually looking for a buying opportunity, things of that manner, and this can be an actual buying opportunity. Now, one of the funny things that I heard over the course of the last couple of days is everyone wants a great buying opportunity, but no one wants the risk that comes with the buying opportunity. So with that, we would like to just open this up for questions. If you do have questions, please type them in. We'll just spend just a couple seconds waiting. If there are no questions, thank you for attending.
The first question is from Adam, and the question is, can you speak about REITs, which are real estate investment trusts, and how they might be impacted by the downturn in the market? REITs historically have been a non-correlated asset class. So if you're in a non-publicly traded REIT or a privately held REIT, which is generally what we'd recommend to our investors, those types of investments keep their share price value very stable, and they keep paying their investment returns or their dividends to investors. So typically, they are not affected by stock market volatility because your REITs are a pool of properties, buildings that have tenants, and the REIT company basically collects the rent from the tenants every month and then pays that to you on a monthly or quarterly basis in a dividend. So we're not seeing much volatility in the privately held REIT arena.
Next question is from Don, discussing about the fact that China seems to be driving a lot of this activity, and what is kind of the perspective that needs to happen in order for China to stabilize their economy. A couple things we need to kind of be aware of here. Now, over the course of the last number of years, China has orchestrated some of the slowdown in their economy, and that has been something that they wanted to do because they were really growing too fast. Well, they've gotten their wish, and they started to now go back into, they're not in a recession territory yet, but they're getting close to that, and that has driven a lot of the market volatility in their own stock market. What do they need to do to right that and correct that? We're already seeing steps that they're taking. On the last day, they've come out and decreased their interest rate, so they had an interest rate cut. I think this is their fifth one in the better part of about 9 months. They've come out and lowered their reserve requirements for their banks. This is another, I think, the fourth one in about the same amount of time. And so what that's going to do is help stimulate the lending, much like the quantitative easing did here in the U.S. As that continues, as that works, you're actually going to start seeing more and more of these things pick up. But the real thing that really needs to happen in China is their housing really needs to start working again. And as of right now, they're getting through a housing glut, and that has caused some of the commodities to go down in price because they're not using as much. Well, that is something that as they work through that glut of housing, start growing their housing again and actually starting to work towards their growing the middle class, which the Chinese government wants to do, that will turn the markets. Now, some of this is long-term, but there are some very, very short-term natures they can do to shore up the confidence in their stock market. That is something that we're already seeing happening. So as they continue to do that, we should see their stock market start righting itself a little bit, and likewise, that will reduce the volatility here in our own markets. If there are no other questions, Sean, do you have a last word before we sign off?
No, but thank you for joining our conference call today, and we plan to have a series of webinars that we'll be starting up with in September or October with various financial planning subjects, and I hope this was all of benefit to you, and have a great day, and hopefully you all get to the State Fair. Thank you.